Okay. All right. So once again, welcome to our first accounting session. So this is accounting 1B, right? So test preparation 1, obviously, that's what we're going to be looking at in the 2024 academic year. So as I'm looking at your outline in terms of the topics of note for the test that you're going to be writing, I think let me just outline those topics here. And then we can look at the basic theory outlines that you need to know or that you need to be familiar with. So the first concept, obviously, it's on the bank reconciliation, followed by the debtors or the debtors and creditors reconciliations, right?
Yes, sir.
Right. So I would endeavor to explain beginning with the bank reconciliation today. And then, of course, the other lesson that we're going to have, I'll be discussing about the debtors and the creditors reconciliation. So to do that, there are notes that I want to kindly open for our discussion so that it becomes easier. So let me also fetch my textbook here. I wished I had the soft copy version of this book. I was just going to be presenting it out and displaying it on the screen for you.
That's fine, sir.
All right, no problem. Right, so what I would then do, even as I open the notes and everything, I would refer you to certain page numbers and all, just to give you like an outline of this. So there's a summary I'm going to open just now on your screen. You should be able to see it shortly. Okay, just give me a second to open it. Me. Right. So there's a document that I've opened here. Can you see it clearly on your screen?
Yes, sir.
Right. So this is just a summary that I drafted, okay, over the topic or the concept about bank reconciliation. So I'll be using that summary together with your textbook so that you can see how it connects to your prescribed textbook. So some of the things that I would refer to, it is for you to be able to answer theoretical questions. But what I've explained here on this summary, they are more relative. I mean, it's more relative to essay-based type of questions. Sorry, not essay-based, man. It's more based on the calculation type of questions. So to make it easy, why do companies perform business bank reconciliations? In other words, why do companies perform bank reconciliation? Now, the reason for businesses to perform a bank reconciliation, it is because of one of the following reasons. Ideally, it's because of the differences in the cash book of the business and the bank statement which comes from the bank. So the differences between the cash book of the business against the bank statement from the bank. So what is it that causes the differences between what we have in our accounting records and that record, which is obviously in form of a bank statement, which is generated by the bank? What is it that causes those differences? Well, it's simple. It's because of some of the following reasons, like it could be because of the timing differences. Are we together? What do I mean when I'm saying timing difference? Let's say you're doing your bank reconciliation at the very last day of the month of August, which is the 31st of August, and then you receive a payment in your bank account from a client and it's not an immediate payment. So what would happen is, while you're getting the bank statement on the last day of the month, that payment from a customer which was made on the 31st, it will only reflect on the 1st of September. Does it make sense? So if it is going to reflect on the 1st of September, so it will not be reflecting obviously on your bank statement, although the money was received. Okay. So it will be a timing difference. But some other times it's not because of that. It could be because of omissions. All right. Sometimes it can also be as a result of errors, natural errors, meaning to say there could be a mistake that we could have made in terms of recording on our side as a business, or there can be a mistake that a bank probably did on their side, you know, and all of those would result in differences between our balances according to the cash book and the balance according to the bank statement. So in order to rectify those differences, that is the reason why we generate a bank reconciliation statement. Are we together?
Yes.
Very, very important. So now there are steps, obviously, that we follow. There are steps that we follow to perform a bank reconciliation statement. All right. There are steps that we follow, and it's very important that you understand those steps. Some of it, obviously, you would notice them as I do the explanation of the summary, but according to your prescribed textbook, the steps to the bank reconciliation statement, they are explained from page number 3. Section 1.3, the bank reconciliation procedure. So I want you to see the 5 important steps that you follow to perform a bank reconciliation statement. Okay? The 5 different steps that you follow to perform a bank reconciliation process. So the first step is to do what? Is to compare credits on the bank statement against the bank column of the cash book receipts. Okay? Compare the credits on the bank statement against the bank column of the cash book receipts. And the differences are identified as requiring amendments or additions in the cash book. Okay, it's pretty much what you have here, which is what I've indicated as step 1 there. So what you do is you compare your cash receipts journal, okay, in the cash book against what appears on the bank statement. So in other words, you're comparing all the monies you have received and that you have recorded in your records, and you want to ascertain whether the records appear on the bank statement. If those cash receipts do not appear on the bank statement, it means they have to be taken to the bank reconciliation statement as outstanding deposits. Are we together, Matugu?
Yes.
So that's the first step you do. So you are looking at your cash book and specifically the cash receipts journal. In the cash receipts journal, remember, that's where we record all the monies that the company have received. That's where we record all the EFT receipts for the money that we have received in our bank account. It's all captured in the cash receipts journal. So if we have records here that are not appearing on the bank statement, those records should be taken to the bank reconciliation statement of the month as outstanding deposits. That's step number 1, even according to your textbook. That's the first step that they are explaining there. So now those differences, obviously, it can be as a result of an error or it can be as a result of an awareness difference. Are we together? An
Yes, sir.
awareness difference, let me explain what it is. So an awareness difference is because the bank was not aware that maybe the business received some money in cash and maybe that money was not yet deposited at the bank. So guess what? The bank would not have that record Why? Because they were not aware that the business received some money in cash. That's what they mean when they are saying awareness difference. Are we together?
Okay.
Right. Then step number two, it's this one here, where you are looking at the cash book payment journal and you're comparing it against the bank statement. So you're looking at all the payments that have been made by the business in cash, all the checks that they've issued, and also the EFT payments that you have maybe perhaps made from the bank. So you're looking at those records that you have recorded here that relate to cash payments. If those records are not appearing on the bank statement, it means they have to be taken to the current month bank reconciliation statement as outstanding checks or outstanding EFTs. Are we together?
Okay.
Right. So now that step number two, it also incorporates what we are looking at here, whereby you are looking at your bank statement and you're looking at items which are captured on the bank statement, but which may not be appearing in the cash book. Now, these items on the bank statement, which are on your bank statement, but not in the cash book, it can relate to any of the following that I've enlisted in bullet points. So it can be a direct transfer. A direct transfer on the bank statement, it's a transaction which relates to a payment which was directly made from your bank account to pay another person to pay another person through their bank accounts. Are we together?
Okay.
Very, very important. That's number one. Direct deposit, it's a case where somebody deposits money directly into our bank account. So it's either they are doing it using their, like from their account direct to our bank account. That's a direct transfer. All right. I mean, that's a direct deposit rather. Or they can just simply take cash and then they put it directly into our bank account. All of that is equivalent to a direct deposit. So a direct deposit, it simply means we have received money to our bank account. That's what it means. And then there's
Okay.
something called a debit order. A debit order, it's you instructing the bank to pay a particular person on a particular date at a specific amount. That's a that's a debit order, all right, or a stop order. So it's an instruction that you give to the bank, instructing them to say on this day, pay X amount of money to this particular person. That's a debit order. So it could be a debit order for insurance. It could be a debit order for a loan payment to the bank. It could be a debit order maybe for a payment for a motor vehicle that we acquired on credit, something like that. But essentially, a debit order, it's a payment. Are we together?
Okay.
So I've also given that explanation here. It's an instruction given to the bank by the business to pay a particular party on a specific day of every month for a certain period of time. So it can be, for instance, an installment of a motor vehicle, maybe it was purchased on finance. So if you instruct the bank to pay 4K on the 7th of every month for 5 years, that's a typical example of a debit order. So now I want you to observe some few things after I've explained these things. There's also something called bank charges. Bank charges, it's the bank charging you for using their banking facility. So it's a payment out of your bank account. So when you get your bank statement, it will reflect as money going out of your bank account. Same thing with the debit order. It's an expense, obviously, so it will be reflecting as money going out of your bank account. However, with a direct deposit, because you are receiving money, it will reflect as inflow of money to your bank account. Direct transfer, it's a payment, so it will reflect as money flowing out of your bank account. And then, of course, sometimes, but which is under rare cases, there's what we call RD checks, which can also be reflected on your bank statement. Now, a return to draw check or RD check happens under the following circumstances. Somebody gives you a check and they say, okay, we are authorizing you to go and draw the money from the bank. When you get to the bank tells you, there's something wrong. Maybe they did not put in the right details on the check. It could be an error in terms of the fact that the signature of the person that authorized the check and the signature that the bank have, they are not corresponding. So obviously, if they are not responding, corresponding, then it follows that the bank would not allow you to take the money. So what do? You have to return with the check to the person that drew the check. So that's where return to draw a check emanates from. But sometimes it's not because you received a check from somebody that was paying you. It could be you as a company that issued a check to someone, and that person comes back and they tell you they could not withdraw the money. So again, it can result in a return to draw a check, right? But I'll deal with that one as a separate thing. But essentially, what you see in bullet points, these are items that are commonly captured or reflected on the bank statement, but hardly would you then see these being already captured on the cash book side. Why? Because the cash book, young men, cash book is your company records. These are internal records. So under normal circumstances, we do the recording in those books on a day-to-day basis. And normally it's things that we are dealing with on a cash by cash basis. So hardly do we see a lot of involvement of the bank per se. We only deal with the bank normally maybe at the end of the month. But sometimes if we record our transactions from the bank on a day-to-day, we might find some transactions which are on the bank statement already captured in our cash book records. But anyways, so usually for a direct transfer, because it's a payment, right? And it's on the bank statement, but not on your cash book. Ideally, you take it to the relevant cash book record, which will be the cash payment journal. Why? A direct transfer, it's usually a transaction resulting in payments being made out of your bank account. So it's a payment. It has to go to the cash book payment journal. Number two, direct deposit. It's a case where you are receiving money, so it has to go to the cash book receipts journal. That is if it is not yet there in your cash book receipts journal. A debit order, you're instructing the bank to pay someone, so it's a payment. It has to go to the cash book payment journal. Bank charges, it's payments that you've been charged by the bank for using the facility, so it has to go to the cash book payment journal. Now, with the return to draw check, young men, you always need to look at the source of the person that issued the check. So if you know who issued the check, you would know what was the intended purpose of that check in the first place. So for example, if an RD check comes back to the business, and maybe you as a business, suppose you are a law practitioner, okay? So you're a law practitioner, and then it means an attorney. If you had issued a check to someone and you were paying them, right? And then the person comes back with the check and they say the bank could not allow us to get the money. So obviously it will be a return to draw check. So initially the check was drawn so that you could what? Make payments. When you do the correction or recording of the RD check, you record it in the opposite book, which will be the cash receipts journal. Does it make sense, Matugu?
So can you please repeat? I'm not understanding 100%.
Okay. So what I'm saying is, with a return to draw check, the most important thing is to look at who issued the check first and what was their intention when they issued the check in the first place before it became an RD check. Right. So now if it was the business that had issued the check, it means the business was paying someone. That was their intended purpose in the first place. So it would have already been recorded in the cash book payment journal. But now somebody comes back and they say, no, we could not manage to take our money. So when they return back that check to us, when we record that check in our books, we record it in the opposite of this book, which will obviously be the cash receipts journal. So initially, we had recorded it as a payment in the cash book payment journal, but when the person comes back with the check, we record it in the opposite of the cash book payment, which in this case is the cash receipts journal. Is it making sense now?
Okay, yes, sir.
Now, so that was in the case when we as a business had issued the check, and now it is a return to draw check. But sometimes it can be a customer or a client We had issued a check to us and it bounces back and it is obviously regarded as an RD check. So if the customer had issued it to us as a payment to us, we would have recorded it in our cash receipts journal. But now because the check is a return to draw check, if we had recorded it in the cash receipts journal in the first place, when we do the recording of the RD check, it will be in the opposite, which will be the cash payments journal. Does it make sense?
Yes, sir.
So with the RD check, always check who had issued the check in the first place. If you know who issued the check in the first place, you would know what was their purpose in the first place. And then when you do the correction of that, recording, it will always be the opposite of where they had intended the check for in the first place. So if I know it was the business we had issued, if it was the business we had issued the check, automatically in your mind, you know they were paying. So when I record the RD check, I record it in the opposite, which will be the cash receipts journal. If it was a customer that had issued the check to us and now it's a return to draw check, guess what? The customer was paying us, so we had initially captured it in the cash receipts journal. So when we do the recording of the RD check, it will be done in the opposite, which will be the cash book payment journal. That's how you handle return to draw checks or RD checks. Are we together?
Yes, yes, sir. Yes.
Wonderful, wonderful. Okay, so that was step one. And step number two, what I've just explained to you about records in the cash book receipts journal, records in the cash book payment journal, which are not on the bank statements. And also this, and then of course I told you that you take them to the bank reconciliation statement for the current month. And then for the items which could be on the bank statement, but not in the cash book, where do you take them? You simply take them to the cash book. All right. So all of that is step one and step number two of your bank reconciliation procedure. Are we together?
Yes, sir.
So I've been touching page 4 and page 5 of your textbook with what I've just explained to you now on your screen. So I'm now on page 5 of your textbook where I'm dealing with step number 3. So according to your textbook, step number 3 is where you deal with differences identified as requiring amendments or additions in the cash book are recorded and the cash book is totaled. That's basically what we've just done now here. So items on this bank statement, but not in the cash book, they are taken to the cash book. That's exactly part of step 3 as well. So we've already dealt with that. Step number 4 is to compile the bank reconciliation statement. So that is this part here where you have to compile the bank reconciliation statement. So I'm going to deal with that. But I want to explain a few other things which still forms part of step 1 up to step number 3. And it has to do with errors, okay? It has to do with errors. Now, young men, in your books as a company, all right? In the cash book, because remember the cash book, it's what you have as your internal records as a business. In your cash book, you can make some mistakes in recording of certain transactions. Now, those mistakes or those errors that you make, we call them cash book errors. Errors made by the business in their cash book, we call them what? Cash book errors. And then on the bank side, they can also make a mistake. And those errors that the bank makes, we call them bank errors. Now, if there are mistakes on the cash book, young men, on the cash book, those mistakes that are made in our cash book, we correct them in the cash book. Errors made in the cash book, they are corrected in the cash book. Now, let's explain the typical type of errors which we can make in our cash book side. So the first type of mistake or an error that can be made by the accountant in the cash book, it can be an overstatement. An overstatement, it's a case where you record more than what you were supposed to record, whether in the cash book payment journal or whether in the cash receipt journal. Now, here is the issue, or here is the catch with overstatements. If you were supposed to record a certain payment, okay, and I'm going to illustrate with an example. So let's explain what an overstatement is. So let's say you made an overstatement in the cash payment journal. When you do the correction of the overstatement error, you record it in the opposite book, which will be the cash receipts journal. Very important. So hence here, you can see with the explanation here, when you correct an overstatement, you always correct the overstatement in the opposite book of where the error took place. So if the error took place in the cash receipts journal, where do you do the correction? It is done in the cash book payment journal. Are we together, young men?
Yes, yes, sir.
So let's assume you paid, okay? You paid rental offices. Office rentals for 4.5. All right. You paid 4,500 for rentals for your office. And then the accountant records 5,000 rands. Okay. Maybe in the cash book payment journal. Right. If that was the case, it means there was an overstatement of how much? 500 rands, because you're only supposed to have recorded 4.5. So that 500 rands difference, it will be captured where? In the cash book receipts journal. Because actually the error took place where? In the cash book payment journal. So when you do the correction, you'll be recording it in the opposite of the cash book payment, which is the cash receipts journal. And you record the difference, which is the 500 rands. Does it make sense?
Okay. Sir,
Yes.
so basically, if you're paying something, then you're gonna have to record it in the CPJ. But if it's an error, then you're gonna have to put it back in the CRJ.
Yeah, if it's an error where you recorded more than what you paid. So let me try to create a different example. Yeah? So I wanna deal with remember we're dealing with overstatements. I think let me start it from scratch. It will make more sense. So an overstatement is a case whereby you record more than what was actually received or actually paid. So you're recording more than what was actually received or more than what was actually paid. So let's start with the part where it's a payment, okay? So it's an overpayment, all right? So it's the overstatement is a case of a payment. So you paid, so I'm gonna give you a transaction, all right? Paid rental costs to the value of 4,500 rands. Then the accountant recorded 5,000 rands as office rentals in the cash payment journal.
Mm-hmm.
You see what happened there?
Yes.
But then remember, the actual amount was what?
4,000,
4,500. But what did the accountant did? He recorded what?
5,000.
5,000. So do you see that he recorded more than what was actually paid? Can you see that?
Oh, okay. Oh, yes, yes,
You see the
yes, yes.
logic. So instead of
Yes.
recording 4.5, what did the accountant did? He recorded 5,000 rands. So do you see the overstatement of the
Yes.
payment? It's by how much?
500.
It's by 500 rands. That's the way the overstatement is. So he recorded more by at least 500 rand. So if it's an overstatement of a payment, it is corrected in the opposite book. So it is corrected in the,
Receipts.
exactly, in the CRJ. So remember, where did the error occurred? The error had occurred in the CPJ, but when we do the correction, we do it in the opposite book, right? So what is the opposite book of the CPJ? It is the CRJ. That's how overstatements work. So when you look at a transaction, assess the error to say, did they record more than what was supposed to be recorded, or did they record less? If they recorded more, whether it's a payment or whether it's a receipt, just identify where did the error took place. If you know where the error took place, you'll know where to correct it. So obviously in this case, it was a payment. So it means the error took place in the CPJ. When we do the correction, we correct it in the CRJ and we record the difference in the CRJ.
Okay.
So in the CRJ, you would be recording correction of errors, and the amount it has to be 500 rands. All right, let's connect again for video B, young man, and then we proceed. Is it fine?
Okay, no stress.
Away, away.
All right, sure.
All right.